Omaha, Nebraska. Nestled against the Missouri River and close to the Iowa border.
$100,000 a year.
That's what you're paid?
Yeah.
The board of directors thinks that you're worth $100,000 a year?
Well, I don't ask them, actually.
It's widely known that billionaire investor Warren Buffett, one of the world's richest people, proudly hails from Omaha. His holding company, Berkshire Hathaway, is headquartered here in Omaha, and once every year, over 40,000 people from all corners of this spinning globe converge to listen to Chairman and CEO Warren Buffett and Vice Chairman Charlie Munger preside over the Berkshire Hathaway annual meeting.
It's so interesting to watch you work and talk.
I have to give people hope that Warren has 7 more good years in him.
Nicknamed the Woodstock for Capitalists, this year the pilgrimage of shareholders includes your equity mates, Bryce and Alec, as they give you the chance to learn from the world's best investors.
But life has been awfully good to me and Charlie, so we have no complaints.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to another episode of Equity Mates, coming at you from downtown Omaha as part of the Equity Mates on tour in the USA. Welcome. If you're joining us for the very first time and still trying to get up to speed, you can go over and check out our Get Started Investing podcast. Otherwise, thank you for joining Alec and I on our journey of investing as we try and break down your barriers from beginning to dividend. Now, while we are licensed, we are not aware of your financial circumstances. So any information on this show is for education and entertainment purposes only. Any advice is general. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited. This is our first of our USA interviews. We went halfway around the world to speak to some of America's best investors, and we saw America's or history's greatest investor speak. Still haven't quite landed that interview, but this is with a fund manager, Jeremy Kokemor, who we first read his investor letter about 6 months ago, just came across it on Reddit, and 6 months later we met him at a hotel in downtown Omaha. Yeah,
it was pretty awesome. So before we introduce Jeremy, a massive shout out to Milford for sponsoring the Equity Mates US tour. It wouldn't be possible without them. Milford are a leading New Zealand fund manager, and they are now available for Australian investors and advisors.
Milford's flexible active management strategies and high-performing, globally experienced investment team aim to deliver strong long-term returns while managing downside risks.
Now, Milford's team also invest in the same funds as their clients, and as you'll hear in Jeremy's interview, that is very important. So you know they are highly motivated because they're on the journey with you.
Find the Milford funds on your trading platforms or at milfordasset.com.au, and before you invest, be sure to read the fund's product disclosure statement and target market determination found at milfordasset.com.au. Massive thank you to Milford for sponsoring our US tour. But Bryce, on to today's guest. Tell us about Jeremy.
So Jeremy pursued a career in investment management after he graduated from the University of Virginia and Harvard Business School. He also had a stint at T. Rowe Price and is now the founder of Right Tail Capital. They're an investment firm that focuses on buying undervalued, high-quality businesses through fundamental research. And we really get a sense from him about how Buffett and Munger actually really shaped his investment philosophy.
Yeah, well, without any further ado, let's take you back to Omaha and our conversation with Jeremy.
Well, Jeremy, welcome to Equity Mates.
Great to be here. Yeah, great to see you, Bryce.
So, Jeremy, as you said offline, you've heard on our show before that we start our interviews with a game of BizNerdle.
Sure.
The Equity Mates daily company guessing game.
Okay.
We've got 5 clues.
5 clues.
It's an American listed company.
Okay.
And after each clue, you can guess.
Okay.
Yeah.
Or you can say, next clue, and we'll give you the next clue. So, clue number 1. In January 2023, my stock rose over 100% after I announced I would use ChatGPT's AI for content creation.
I don't have a ton of confidence in this answer, but I'll go ahead and say Meta.
Not Meta. Second clue. My first viral hit was a listicle called The 28 Funniest Photos of Cats Being Cats in 2008.
Another wild guess. I'll say NVIDIA.
No.
Okay, so clue number 3, I am known for producing articles, lists, quizzes, online content, and videos of a variety of topics.
Next clue.
According to the New Yorker, in 2014, I deleted over 4,000 early posts, quote, apparently because as time passed, they looked stupider and stupider.
Twitter?
No, along those lines, final one, my stock ticker is BZFD.
Oh, BuzzFeed?
BuzzFeed.
Yes. Wow.
Yes. Tough one. I remember when the stock, it was 100% overnight the stock went up.
Because they said they were going to
Because
use
they came out and said
ChatGPT, yeah.
What's the
gonna-
market cap of BuzzFeed? Any idea?
Oh, it would be a lot smaller this year than
Pretty
it was.
small,
Yeah. I think they actually, because they had a news division, but I think they've announced they're shutting it down.
That's a good one. You guys stumped me on that one.
Yeah.
So the market cap is, it's only 84 million.
Wow.
Yeah.
Really?
Yeah.
Oh, I think we can hazard a guess that it's not in your portfolio.
Not in my portfolio. Yeah.
But you're going to go research it. No. So Jeremy, let's kick off. We'd love to start with a little bit of a background about yourself and how you came to found Right Tail Capital. But there is an interesting story about how we connected. So perhaps if we want to start there.
Sure. Happy to, Bryce. So the way I originally heard of you guys and the great work you're doing is, anytime someone signs up on my website to receive my letters or any communications, I'll always reach out to them and try to learn a bit about their background and their interest in investing. And oftentimes it's maybe someone I've met before or someone who saw my letter posted on LinkedIn or something like that. And this one gentleman actually said he heard my letter being read on the Equity Mates podcast. So I was, immediately intrigued and wanted to learn more about you guys. And there are several amazing things about it. One is just the great work you guys are doing over in Australia, kind of across the world. But a big part of my investment philosophy, and we'll get into that, is owning high quality businesses over the long term and not trying to overly predict macro occurrences, even though I want to be aware of the macro environment. And so in this letter we're talking about, which is very appropriate for where we are today in Omaha at the Berkshire Hathaway shareholders meeting, is I spoke about how, Warren Buffett's always getting asked about interest rates and geopolitical concerns and things of this nature. And when I'm listening to the old Q&A from his annual meetings, I can never figure out, unless I see it beforehand, I wouldn't be able to guess what year he's giving these answers in, because he's always getting asked the same questions, maybe just a little bit of a different flavor. And you guys bounced it off each other so well, played the guess the year. It sounded like it could have been 2022 because we were talking a lot about rising interest rates and the impact on valuations. And if memory serves, I think it was actually 1997. So anyway, that's how I originally heard about you guys.
Well, where did I just want to know where that guy was based in the US, because it's awesome that our content has actually made it over to the US.
It was actually a gentleman based in Australia.
Oh, there you go.
Yeah, so
Okay.
I think he had heard the podcast. Yeah.
Nice.
Well, I think it's the great thing about, the internet and the fact that, you're based in Virginia writing letters for your investors, your clients, and, us on the other side of the world can just stumble across it. I think I came across it on Reddit.
Awesome.
But it's just
Awesome.
like such there's so much information out there and so many people sharing their knowledge. You just got to start looking.
Sure. And since I've been, since I founded Right Tail and I've been writing the letters, the sharing of the letters and the knowledge has led to so many great friendships and relationships. And so the opportunity to sit down with you guys is, one I never would have dreamed of several years ago before founding Right Tail. So just incredibly grateful for that. I can share a bit about my background. So I grew up in New Orleans, Louisiana, which is kind of, down in the southern part of the United States. And, maybe for some of your listeners, whenever folks hear I'm from New Orleans, New Orleans is a very unique place in the United States. There's a ton of music, ton of culture, great food.
We've been there, and Bryce, are they the Hurricanes? Is that the drink?
One of the
drinks.
What's the strip called?
Well, there's a Bourbon Street.
Bourbon Street, yes.
Yeah, Bourbon Street.
Bryce isn't allowed to go back there.
Bryce isn't allowed to go back.
Well, I'm a massive jazz music fan, but I went with a couple of mates who are massive drinking fans, and so we just spent all of our time on Bourbon Street.
Yeah. Well, you can find sort of any flavor of activity in New Orleans. In university, I brought friends back to New Orleans 3 of the 4 years for Mardi Gras, and we would do kind of a whole sampling. We would go to some good restaurants. We would do maybe one night on Bourbon Street, but Mardi Gras is also a big family activity as well. As a kid, we would dress up in costumes, kind of like Halloween, go sit on the parade route, catch cups and beads, and I took my kids for the first time last year, which was a ton of fun. So it's a great place to grow up. Still love. I cook jambalaya for friends and red beans and rice and some of the great Cajun cuisine that's down there. So I grew up in New Orleans, went to the University of Virginia where I studied economics and history, worked for a few years in investment banking and investment management, then went to Harvard Business School during the great financial crisis, which was just a fantastic life opportunity to meet great folks from all around the world, learn with them, learn from them. And then since graduating from Harvard Business School in 2010, I've solely been focused on investing in public equities, first at T. Rowe Price, large kind of global long-only investment manager. And then for the 10 years or so before Rightail, I was managing concentrated portfolios, most recently with Thompson Segal and Walmsley in Richmond, Virginia. And so, this is what I've always loved doing. And the opportunity to start Rightail has been a long-term dream of mine. And really, the original premise was, look, I want to, invest for as long as I can think straight. And I want our family's investments in Rightail to be our family's primary source of wealth creation. Even if no investors, were to join me or the business didn't produce any revenue, that's okay. We'll keep investing in high quality businesses and try to pay very undervalued prices for them. And so that was really the original premise behind starting Rightail.
And so for all those budding fund managers out there, at what point did you feel like, or how did you know, this is the time that I'm going to go out on my own?
Sure. There's never going to be a perfect time. If you want to do it, at some point, you really need to just kind of step up and do it. And I liken it a bit to when my wife and I first decided to, potentially have children. And we're very fortunate to have 3 awesome, healthy children. We have 2 girls, Caroline and Claire, who are 12 and 8, and a son named Will, who's 10. And I liken it to that thought process around having children, because you can try to be as prepared as you possibly can, and maybe you have some savings and you've bought a house and your marriage is healthy and all these things, but there are always going to be surprises and things that you didn't envision. And I would say the same thing with starting Rightail. For most of us who want to start an investment firm, there's not going to be someone who shows up with a pot of gold and an answer key and says, now is the time, you should go ahead and do it. But if you want to do it, at some point you just have to do it, and just kind of put one step in front of the other, and try to build that dream that you've always had.
Now, we've touched on a few elements of your investment philosophy, but it'd be great to really unpack it in detail. So you go out on your own, you start Rightail, and I think you write an initial letter to your investors outlining how you're going to invest. Can you give us the key points from that?
Absolutely. So I'll briefly mention the name Rightail was the one name that really resonated with me. And there were really 4 points from it. One is, if you think of a normal bell-shaped distribution curve, I want the returns, the long-term after-tax returns, to be excellent and to be in the Rightail. Secondly, I'm typically going to be investing in higher quality businesses that have already proven themselves to be exceptional, or to kind of be in the Rightail versus their peers or companies at large. And then there were 2 personal reasons. One is just, similar to compounding, and how, a little bit of better returns can just lead to dramatic wealth creation over time, and no better examples than Warren Buffett and Charlie Munger. And I love the process of how do we all get a little bit better or a little bit smarter, whether it's investing, whether it's health and fitness, whatever the case might be. And then the last piece was I didn't grow up with much in the way of financial resources. And so the opportunity to manage someone else's wealth and savings and hopefully improve their financial outcomes over time is one that I take really seriously. Now, the investment philosophy is really just about buying high quality businesses at a fair to below average price. And when I think about quality, there are several qualitative and quantitative factors that I think about. On the qualitative side, I really want to understand what are the company's competitive advantages and why are they, stable to getting stronger over time. And then the way that may manifest itself on the quantitative side is I really want to find businesses that are producing high incremental returns on capital. So it's great if a business has had historical returns on capital, but what do we think about the next 5 years or the next 10 years? So high incremental returns on capital. And secondly, hopefully the business has a long reinvestment runway so they can take that cash that they're producing each year and reinvest it back into the business at a high rate of return. I don't have anything against companies deciding to pay dividends or repurchase their shares, and that can be fantastic as well for long-term shareholders, but I'd rather find a business that can continue to reinvest at high rates of return.
Now we're sitting here on the second level foyer of the Courtyard Marriott at the the Woodstock of Capitalists?
Woodstock for Capitalists.
Woodstock for Capitalists here in Omaha. Is it fair to say, Jeremy, that Buffett and Munger have really shaped exactly what you've just spoken about?
They've had a dramatic influence on me as an investor, and even some things, in terms of how I'd like to live my life as well. There are just so many things that Warren and Charlie talk about. And some of these things have kind of hit me at different points in my investing journey. So recently I've been spending a lot of time thinking about Munger talks about how he doesn't worry about the mistakes he makes because he knows that everyone's going to make mistakes and you can't really avoid them. So why don't you just kind of accept that? And, over the long term, your winners will do really well. So that's one thing I've spent time thinking about lately. I've spent a ton of time thinking about just the dramatic impact that a small number of positions can really have on investment performance. And then they do such a great job of keeping things simple as well. So those are a few things that come to mind. But, then on the life side, I love Warren's point about, why not, have the second half of your life, be better and more enjoyable than the first half, and I think that has just dramatic implications for, let's just treat each other nicely and with respect. And over time, that'll probably lead to, more, happiness and serendipity and great relationships and things of that nature. So several impacts that have, determined how things go kind of day to day at Rightail.
There's definitely a romantic notion about Warren's life. He bought the house decades ago and has lived there ever since. So much so that Bryce and I are going to drive past the house at some point this weekend just to
nice.
say it. Yeah, have you seen it?
Maybe I'll come with you.
Yeah.
A friend of mine swung by yesterday and showed me a picture of it. So yeah,
there's a concept that we were talking about before around alignment, and I think that Buffett is the ultimate example of an alignment between investor and shareholders. Literally, I think all of his wealth, maybe except for that house, is tied up in Berkshire shares, and that's something that you were mentioning offline is important for you as well with Rightail.
Yeah, so several parts of how I've set up Rightail, I've tried to create as much alignment with all of our investors, who are largely people who are, great friends and family members that I've known for a really long time and, want us to just continue to learn and invest and grow together. So from a fee structure standpoint, I've always been enamored by the original Buffett partnership fee structure, which did not have a management fee and only charged a performance fee. So as I was starting Rightail, that was something that was always in the back of my mind. And I have two fee structures currently, one that is the exact Buffett partnership fee structure. And then I also have a structure that is management fee only, primarily to give investors a choice as to, kind of what makes the most sense for them or makes them happiest. So that's one area where Buffett has had a big impact, and alignment really matters to me. The other piece, Ren, is really just around, to me, it should be table stakes in this business for the investment manager to invest right alongside, each of his or her investors. And so, our family has the vast majority of our liquid net worth invested in the same portfolio that each of our retail investors owns. So we'll win together, we'll suffer together from time to time. Over the long run, when we look back in 5, 10, 20, 30 years, I think we'll be really happy with the results, but there's a key piece of, hey, we're all gonna do this together.
Yeah, it just feels like, for me, the most important thing when you're looking at all of the active managers you can choose from, like that sense of alignment and like the wins and losses are shared with the manager. It feels like the most important thing, but you don't really hear it discussed a lot. You hear much more about investment philosophy and time frame and stuff like that, but just that sense of alignment, for me, would be the number one thing I look at when I'm choosing an active manager. Yeah.
Well said.
Yeah. So let's in saying that, let's now drill down on your philosophy a little bit more. Concentration is something that I think is really interesting, and you run quite a concentrated portfolio, just 8 to 15 positions, which, when your portfolio is at 8 positions, you'd have to think that's one of the more concentrated portfolios that you'd see out there. Why that philosophy, and how do you manage that, when markets are volatile like they are now?
So today I am closer to the higher end of that 8 to 15 range. And that's primarily just as I have been building the portfolio over the last year. There have been points in time where it just seemed like the opportunity set was fantastic. And rather than get bogged down in the position sizing or the exact number of positions, I thought, we had kind of a mid-teens number of excellent positions. And so, I decided to go about it that way and to just kind of keep, researching those current names and to research new names as well. To get to your point around concentration, to me, this number of securities is ideal and accomplishes several different things. One is concentration really allows your winners to have a very punchy impact on performance, right? And we really care about long-term great performance. So that's a fantastic piece of it. Another piece is most of the research that I've read over the years suggests that you still get an excellent amount of diversification, even owning what sounds like a relatively small number of securities. And so I try to have the portfolio be as diversified as possible and to have idiosyncratic investment cases for the names that I choose to own. So that's a big piece of it as well. And then a big piece of any investment management business is how one, spends his time. Again, I think the concentration allows a punchy impact on performance while also, allowing one to really focus their time on the names that matter most ultimately to the portfolio.
Now, are you USA only when you're looking at these names, or, have you looked at any Australian names for the portfolio?
To date, I'm all North America in terms of my investments, but I'm always trying to learn from other companies, and things of that nature. So nothing in Australia, one Canadian name, but yeah, really just trying to, find and learn from, some of the best businesses and managers around the world, which can be anywhere.
Some high quality companies in Australia. If you like mining, a lot of mining in Australia.
Right. Well, it's funny. I mean, one of the most formative experiences in my background was my first opportunity at T. Rowe Price, which was right after the financial crisis. And it's a great firm with a lot of different investment styles and typically very little employee turnover. And there was basically zero turnover during the financial crisis. And so my first assignment was to cover small cap metals and mining. Oftentimes these businesses had CapEx budgets to build one mine. So they didn't have a mine in production, and the budget to build the mine was often larger than the enterprise value of the business. So they're constantly raising capital, maybe, certainly presenting the more rosy side of any projections that they have. And that was a really formative experience, for me as an investor. There are lots of different ways to make money, and I know some great mining investors, but it kind of helped me realize that, that wasn't where my passions or strengths lie, and I'm really thankful for that opportunity.
Equity Mates, we're going to take a quick break. On the other side, we're going to go stock specific with Jeremy. We're going to unpack one company that's in his portfolio and also an industry that's piqued his curiosity at the moment. But before then, Bryce, let's say another massive thank you to Milford for sponsoring our US tour.
That's it, Ren. Do you want to give your portfolio an offensive and defensive strategy?
Yes.
Nice. Well, check out Milford's award-winning Milford Australian Absolute Growth Fund. Utilising the skills of Milford's experienced investment team, the Milford Australian Absolute Growth Fund has been focusing on delivering a smoother journey for investors for over half a decade.
With an emphasis on managing risk and generating absolute returns, this lower volatility equity fund can play a key role in a diversified portfolio. The fund strives for long-term capital growth while mitigating the ups and downs typically experienced when investing in share markets.
You can find the Milford Australian Absolute Growth Fund, ticker symbol MFOA, on your trading platform or at milfordasset.com.au. Now, before you invest, please be sure to read the fund's product disclosure statement and target market determination found at milfordasset.com.au.
This is Equity Mates in Omaha at the Berkshire Hathaway Annual General Meeting.
We are here with Jeremy Kokemor, the founder of Right Tail Capital.
So, Jeremy, with such a concentrated portfolio, you've got to have high conviction in what you're investing in. So we'd love to understand your process of actually finding opportunities and then drilling down to actually making that investment. And you spoke about car dealerships in your Q1 letter. If we can use that as a case study for your process of understanding an investment opportunity and then how you translate that to making an investment, we'd love to hear it.
Sure. Yeah, I think that's a good one to talk about, Bryce. And to be clear, I have spent a lot of time on car dealerships lately. I have several investments that touch on, sort of the broader auto ecosystem. Have had investments in auto parts retail and the salvage industry and certain other investments. I haven't actually made an investment in a dealership to date, but the way that project really started is these companies have clearly over-earned during COVID because car prices went through the roof and there wasn't a lot of supply and consumers had a lot of cash in their pockets. So there's this interesting dynamic where earnings have been really high, probably too high, and headline valuations are really low. So I was like, all right, that's kind of an interesting setup. On top of that, the long-term shareholder returns for several of these car dealership companies, if you've looked over 20 years, they've compounded at really high rates and have had good returns on invested capital. So it's like, all right, this seems like a fruitful place to spend some time. And so that was kind of how the whole project kicked off. And if we were to almost erase COVID and assume it didn't happen, and just look at the normal earnings growth that these businesses have historically produced, the valuations still seem fair, to attractive for me. So that was kind of why I spent a lot of time there. I've talked to folks at private dealerships. I've talked to the public companies. I've read their transcripts, their SEC filings, all the things I would normally do to study an investment. Ultimately, I haven't made an investment so far, really for two critical reasons. One is there is a potential long-term change to the business model that, and you mentioned the word conviction, I could see it going several different ways. Companies like Tesla have largely decided to get around the dealership network and sell their cars directly to consumers. And so as the car park starts to transition more to electric vehicles, there's definitely some risk or some evolution that could happen to the dealership business model. And given that I tend to think, 5 years out when making an investment, that's continues to be a question in my mind. So that's number one. Number two is, although I like the earnings trajectory of these businesses, if I zoom out and think over the long term, I do recognize that these businesses can be incredibly cyclical and that the last few years have been phenomenal. That's just something that gives me a little pause as well.
It's not something I would have ever really thought much about investing in, car dealerships. Yeah. You kind of think of them as like old school retailers, but then, you start talking about, they've had consistent earnings growth and all of that stuff. And it's an interesting opportunity. But anyway, not one I know much about. Another company that you wrote about in the original letter that we read, it would have been late last year, was Constellation Software.
Sure.
A Canadian company, and a company that we really find fascinating. Do you want to talk a little bit about the company, and again, maybe about your process, when you first came across it, the work that you did to understand it, and how you think about it today?
Sure. Yeah, I'd be happy to. I mean, Constellation is such an intriguing company with a really interesting long-term history. So I always share with folks that, several times, and who knows, maybe this will apply to the car dealerships as well. Several times, or often, I don't make an investment when I do the original research. And two reasons that pop out a lot are, one, maybe I end up not being comfortable with the valuation. And if I'm looking at a higher quality business, maybe the valuation just seems too expensive for me, where I think our returns may not be as high as I'd like them to be. Secondly, I find that the research just continues to build over time. The library continues to expand. And so I may not understand what makes a business truly special the first time I research it. I'll continue to add to that knowledge over time. And then maybe there's a big market sell-off like early during COVID, or something happens to the company. And I mention all this because it's what happened as I researched Constellation Software. So for years, I had been reading the CEO, Mark Leonard's shareholder letters, which are just fantastic. And I don't say this lightly, but he reminds me of Buffett. He thinks very much about returns on capital and how to make great long-term decisions for the business. And so for years, I was reading these letters and I was blown away by his thinking and his discussion. I probably thought in those early years that the stock was too expensive, but the part that I was missing were two things. One is just the incredible returns on capital that they have generated through their acquisition strategy. And two is the runway that they've had for that acquisition strategy. So if we zoom out, Mark Leonard started the business almost 30 years ago in the mid-90s. He's focused on vertical market software businesses, which are often critical pieces of software for their customer. And that matters because customers are less likely to switch if that software is really ingrained in their business processes. And if customers are less likely to switch, then the level of recurring revenue is really, really high. And Constellation, or the business manager, doesn't have to worry each year about how do we refill the revenue from last year. The revenue from last year is largely there, and then we can focus on either how do we sell more to our current customers, or how do we go out and find new customers, or how do we take these all the cash we're getting from these awesome businesses and reinvest that cash. And what Constellation has done, a couple things that have been really rare. One is they've been incredibly disciplined on the price they pay for the software businesses that they buy. And so there's a lot of relationship building that goes into that. There's a lot of discipline up and down the organization. So that has produced just tremendous returns. I've also been blown away by most companies have some amount of stock compensation, either restricted stock or options, that has some dilutive effect on the shareholder base. Constellation went public, I believe, in 2006, and their share count hasn't changed at all.
Oh, really?
So there's been no dilution, and so that just means that the owners of the shares benefit. There's better alignment and benefit even more, and they have a very unique compensation philosophy where Constellation actually requires their managers to take a portion of their cash bonus each year and reinvest it in the shares that way. So it has created, I think, good long-term incentive alignment as the business has performed really well. And so maybe to just kind of tie it all together, I'd been reading these letters for years. Last summer, I started researching software businesses that had high recurring revenue, just to see if maybe with the market sell-off, there were any instances where a good company had just been kind of thrown out or forgotten about. And each time I was digging into a company, I kept finding myself saying, well, let me see what Mark Leonard said about this in one of his letters. And over time, the critical insight for me was, maybe I should really just be spending more time and diving into Constellation, right?
It is just a reminder for me, and I've had a long-term campaign in Australia that Australian brokers give us access to the US market, and they're slowly opening up more and more markets. But Canada, most brokers don't give us access to Canada. And hearing you talk about Constellation is again just a reminder that we need access to the Canadian market. Wow. I feel like this would be an interesting point to turn to valuation because, as you said, Constellation, high quality business, but from a price to earnings standpoint is often seen as quite expensive.
Sure.
So when you were doing that work and you were, in summer last year, you were returning back to Mark Leonard and you were like, maybe I should look at Constellation more. How did you then think about valuation and what was the point where you were like, I'm comfortable with this valuation?
Sure. And you're spot on, Ren, that the headline valuation does not jump out as extremely attractive at first glance. It's not a business that trades for 10 times earnings per se.
As we record, I think it's about 80 times earnings.
Wow.
Yeah. On my numbers, it's historically been closer, like in terms of free cash flow per share. If you look at like next 12 months earnings, it's historically been somewhere in the 25 to 35 times.
Okay. So I'm looking on Google, but that's always looking backwards, isn't it?
Yeah, it may be looking backwards. And, most years they do a lot of acquisitions. And last year they did their biggest acquisition ever. So that could be part of it as well. But your point is well taken in that, if you just invert that 25 to 35 times, we're talking about kind of a 3 to 4% cash earnings yield. Again, doesn't jump out as super attractive. So I look at several different valuation approaches, one being, sort of recent or, sort of near-term earnings multiples. But then another piece of math I do is trying to think of a stock more like a bond. And so that first piece is your cash earnings yield. And then I think about, well, how might that cash earnings grow over time? And I separate the growth into two buckets. So one is growth that can happen without any reinvestment. So two good examples there of businesses that can grow, I would argue, without much reinvestment are, if you're familiar with the bond ratings companies like Moody's or S&P, right? They're sort of the gold standards. And they probably get a little bit of volume growth in most years, but then they also get pricing growth because they're the only ones around. Visa and MasterCard would be another example where they've got the broader payments network. And if you believe that volumes will continue to convert from cash to credit over time, there's some natural growth that's built in there without necessarily a ton of reinvestment. So that's the first bucket, growth without reinvestment. The other growth piece is, well, how much can the business grow by reinvesting? And so there I'm thinking about how much can they reinvest and at what rate of return? And so if we were to zoom out, Constellation shares have probably compounded over the last 10 years somewhere in the 25%, maybe a bit higher neighborhood. So they've been kind of doubling every 3 years, plus or minus, right? And so the math I did kind of suggested there are two critical factors here as I think about Constellation over the long term. One is how much money can they reinvest? which is also a function of how many vertical market software businesses are there to buy, which the company suggests there are tens of thousands of these companies.
And for context for people, they've acquired, around over 300 in their journey?
They're somewhere around 700, I believe, somewhere in that 500 to 1,000. Yeah. And to your point, many of them have been, small, maybe $5 to $20 million of enterprise value. So there's that first piece of how much cash can they deploy each year, and then at what rates of return can they deploy that cash? And so if you multiply those numbers together and put a multiple on it, you can add up those three buckets: the earnings yield, the growth without reinvestment, and the reinvestment growth. And long story short, even if I assume that the returns on capital Constellation generates over time naturally come down over time as they get bigger, that hasn't really happened so far. But to me, that seems like a more logical way to approach the analysis. To me, it seemed pretty reasonable that we could get a 15% annual return or have the stock double every 5 years. And that would be a dramatic slowdown from what the business has produced historically, where it's kind of doubled every 3 years. So who knows, maybe it declines at a slower rate than I'm assuming, but I felt relative to my portfolio, and with this being Constellation being a collection of high quality software companies, that qualified for, a great spot in the right tail portfolio. Separate from that, it wouldn't shock me if at some point Mark Leonard decided to invest outside of vertical market software. That brings some concern with it, but also his investment track record has been so good. And again, I always pause before making the Buffett comparisons, but I think this company and this management team has done such a good job that why sort of unnecessarily interrupt their history of compounding? To me, they've kind of earned the benefit of the doubt after I've done a lot of work trying to understand what makes the business special. To me, the prospective IRR, a little under a year ago, was still fantastic and warranted a spot in the right tail portfolio.
So, Jeremy, you mentioned car dealerships, but we'd love to understand if there are any other areas of the market that are really capturing your curiosity at the moment.
Sure. And as I think about each year, each month that goes by, and I would guess that over time, I'll probably make 0 to 3 new investments per year. I'm not turnover averse, but I think typically it'll be pretty low. Maybe you'll have an occurrence like COVID where great businesses with great balance sheets sell off 50%, and that might be a time to be more active and have more turnover. But really, I think about a key performance indicator for me is just how many businesses am I studying, or businesses that I'm taking to a deeper level of understanding. So that's kind of what I think of as, each year I want that library of knowledge to be growing. So we talked about car dealerships. Another area that I've spent some time studying is companies that run outsourced clinical trials for pharmaceutical companies that have historically had some long-term growth tailwinds. There are concerns today about what the funding environment will look like for new drugs. Just if capital dries up, that might have an impact on biotech or larger pharma companies. And so again, I'm trying to I want to understand the businesses and potentially, if I look out over a longer term horizon, what might the investment opportunities in these companies look like? So that's one area where I've spent some time. But really, Bryce, it's just, trying to turn over a lot of rocks and get to understand businesses better and, and take it that way.
Someone else has spoken to us about this outsourced clinical trials market. And I was just trying to Google the company name and I couldn't come across it. Does it ring a bell?
No.
Oh, okay.
No.
It does make me think, how many great companies have we heard on this podcast that just has sort of gone in one ear and out the other?
We need it, yeah. I think the idea of turning over rocks, like Ren and I often sort of sit back after speaking with people, managers on the show, and and just sort of contemplate what life would be like as a highly concentrated fund manager, spending a day just reading and thinking and
just being curious.
Yeah. It sounds really pleasant.
Yeah.
What does your week look like generally?
Sure. And you hit the nail on the head. And, even if I think about my university experience, I wouldn't have been able to describe it at the time, but I started out in pre-med. I ended up majoring in economics and history. And the key thread that ties it all together is just a love of learning. And so on a typical day, I try to do several hours of kind of primary fundamental research, either on an existing holding or a new company that I'm trying to get to know better. But I also try to carve out some time each day for broader nonfiction reading, because I believe it's all helpful. And just the process of, hopefully learning about different things. And if you're familiar with the concept of consilience, where it's like every little thing kind of builds on itself, and you never necessarily know where the insight is going to come from. Or if I'm reading a book on psychology or physics or whatever, maybe it'll help me have an insight on a company I've been researching. You never exactly know where those insights are going to come from. But yeah, just try to carve out a lot of time for reading and reflection as well.
Sounds nice.
Yeah, Buffett has that quote, being an investor made me a better businessman, and being a businessman made me a better investor. I think we can build on that in saying being an investor made me more curious, and me being curious made me a better investor. Kind of butchered it, but you get what I'm saying.
Well said. And Munger will talk a lot about too, just sort of, I find that a lot of people, it seems like maybe read less than they would like to. And I read a ton, and I would still probably say, I read less than I'd like to. He very purposefully understands that reading has had a big impact on his life. And so he's like, all right, I'm going to prioritize that. And that's something I try to think about as well. And I think we could learn a bit from.
Well, speaking of reading, are there any great investing resources or great investing books that you think Bryce and I and our audience should put on our list?
Sure. I mean, there's so many out there. When you mention investing resources, there's one that I'm subscribed to, and it's a one-man research effort called Scuttle Blurb that does just a fantastic job. He typically posts twice a month, kind of goes in depth on a company or an industry. Scuttle Blurb is someone I've been subscribed to for the last several years, and I think just does a really good job. Often I'll agree with his insights. Sometimes I don't, but it's more the process of, just having thoughtful dialogue in a way of being able to read his work. So that's one that jumps out to me that maybe for your listeners in Australia might be, a little less of a well-known resource. Yeah. Beyond that, there's so many out there. I mean, I'm probably on my third time going through the podcast forms of the Berkshire Hathaway annual meetings,
really?
Which go from, and they start, for whatever reason, the recording started in 1994. So we almost have 30 years at this point. And, like we were talking about earlier, where it's tough to guess the year, there are always just random insights that come out as I listen to these. So sometimes I'll be on a walk, or, I like to run quite a bit too. And so that's one of my sort of podcast feeds that I go back to, pretty regularly.
So Jeremy, we have unfortunately reached the end of our time. It's been awesome, but we do have two final questions to wrap up. So
Sure.
The first one is, we're obviously here for the Berkshire AGM, and Warren and Charlie sit there for about 8 hours and answer questions from shareholders. If you had the opportunity to get up on the microphone to ask one of them a question, what would you ask?
Wow. That's a great question. I think I would ask them, what are the things that have just kind of helped them simplify their investing approach and have had the biggest impact on them from that standpoint. That would be fantastic to just kind of hear a candid answer around that. So I'd probably start there.
Nice. Well, the good news is we all have the opportunity
Yep.
tomorrow. So
Absolutely.
I'll be seeing you at microphone number 12.
Absolutely.
And then finally, Jeremy, each year we host the Equity Mates Awards, and it's an opportunity for us to celebrate experts that have come on the show and really contributed to helping the Equity Mates community become better investors. And so by virtue of being on the show, you are now automatically in the running for the Equity Mates Expert of the Year.
Oh.
And our audience will vote at the end of the year on who they think has been one of the most enjoyable interviews. Now, to help them with the process of choosing who that would be, we'd love to know, if you were to win and receive the beautiful glass trophy, where would you put it?
That's a great question. Obviously, just one I haven't really thought about, really the opportunity to just spend time with you guys and discuss investing and share a bit about how I approach philosophy and hopefully, help learn with, some of your listeners and learn together. That's really why I'm here. If I were to somehow receive the trophy, I'd probably place it in, I work from home, have a small office that I work from upstairs in my home, and I'd probably place it there. But really, the opportunity to spend time with you guys and your listeners is a great reward in itself.
Love that, Jeremy. Well, we're pretty stoked that we got to meet you. It's funny how these things work. 6 months ago, we come across your investor letter online, and 6 months later, we're in Omaha chatting. So thank you for making the time.
Oh, thank you. Yeah, just fantastic serendipity, and really appreciate the work you do. And thanks for everything. It's been fantastic.
Well, we'll see you at the line at 4:30 tomorrow, waiting to get into the AGM.
Sounds good. You bring the donuts, I'll bring the coffee.
Deal.
Sounds good.
Thank you so much, Jeremy. It's been a pleasure.
Thank you, guys.
Equity Mates US Tour is brought to you by Milford. A massive thank you to Milford, who are a leading New Zealand fund manager, and they are now available for Australian investors and advisors.
Milford's talented and globally experienced investment team aim to deliver strong long-term returns while managing downside risks. They also invest in the same fund as their clients.
You can strive for a smoother investing journey with Milford's experienced active management and their award-winning Milford Australian Absolute Growth Fund, ticker symbol MFOA.
Find the Milford Australian Absolute Growth Fund and other Milford funds on your trading platforms or at milfordasset.com.au. And before you invest, be sure to read the fund's product disclosure statement and target market determination found at milfordasset.com.au.
Now stick around, as this Thursday we've got the third and final episode of our Wealth Builders, where we look at two final lessons from Warren Buffett. But as always, Ren, we'll pick it up next week.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.